it's time to get started officially. My name is Mary Biddle-Koenig, and I am the Assistant Director of the Smith Enterprise Risk Consortium, or SERC as we call it, at the Robert H. Smith School of Business at the University of Maryland. I would like to welcome you to the second webinar of 2024 and our monthly Risk Leadership Series, which is brought to you by SERC, ZRG Partners, and the Office of Executive Education at the Smith School. As many of you already know, our webinars are focused on top-of-mind risk topics that vary from month to month. Last month, we chatted about a risk manager's journey between two very different industries. And next month, we'll dive into the Basel III Endgame discussion with Greg Baer. But today, we're thrilled to have Janice Englesbe and Deepak Varsani from Arch Capital with us to talk about the challenges of ensuring cyber risks. I would like to introduce the director of the Smith Enterprise Risk Consortium, Cliff Rossi, who will be our moderator today, and Cliff will continue the introductions. But Cliff is a former risk practitioner with decades of experience in risk management at some of the largest financial institutions, and he was instrumental in the launch of SERC on June the 1st of last year. Now I will turn everything over to Cliff to get us started.
Thank you, Mary Biddle, and welcome everybody to this month's installment of our Risk Leadership Webinar Series. As you saw probably the blurb when you were registering for this event, cyber threats quite simply remain a clear and present danger across the globe to companies, governments, individuals, right? And this risk is rising. I think it was last week, perhaps, the FBI's Director Wray, in testimony to the House Select Committee, laid out in grim detail the full court press that's going on by hostile governments to attack critical infrastructure in the United States, including water supply, electric power, even financial market utilities. And just to give you a little bit more context for sort of where this is going, and I'm sure Janice and Deepak will get into more detail on this. In 2022, the FBI's Internet Crime Complaint Center reported more than 800,000 cybercrime complaints, and there were losses totaling more than $10 billion that year. Over the last 3 years, those losses have amounted to nearly $30 billion. So clearly, cyber risk is near or at the top of most C-suite and board discussions, with cyber insurance one of those ways for institutions to protect themselves from that risk. So I am not a cyber risk expert, but we are very fortunate to have two today with us. We have Janice Englesbe, who is the Chief Risk Officer for Arch Capital, and her colleague Deepak Varsani, who is a Vice President for Risk Management at Arch Capital as well, to discuss the cyber insurance market. So welcome back, both Janice and Deepak, to our session today. And maybe if you would, Janice and Deepak, would you mind maybe spend a minute or so kind of giving a little bit more background on sort of what you do at Arch Capital from that standpoint? That would probably help folks have a little bit better, more understanding than just my Cliff Notes version of that introduction. So Janice?
Happy to, and I'll start, and then Deepak does all the real work, so I'll let him jump in after I describe it because he's doing the heavy lifting. We sit at the group level, so at the holding company. So our job is really to work with all of the departments and entities and subsidiaries across the organization and their risk groups to then aggregate their views and their information to make sure like we have a good view as an entire organization of what our risk position is. Are we, you want to make sure you're not overextended on risk. You want to, so much of it is about having obviously the appropriate framework for managing risk, but then it gets into, do we have the right metrics and the data? So both you make sure you haven't taken on too much risk, but also if an opportunity comes, right? Opportunities, I think, like, they don't wait for you to be ready, right? So if an opportunity comes and the business wants to take on risk, you can fairly quickly work with them and say, hey, yeah, we've got room in our appetite, go for it. Or like, yeah, no, we don't know that we do, so let's not, and let's have a conversation. And so we're really kind of spending a lot of our time going back and forth with our risk experts. So Deepak does the heavy lifting on that, so I'll let him give some more details.
Thanks, Janice. So like Janice said, we work across the organization, and I tend to focus on the exposure side of the risk that comes to Arch, which involves a lot of modeling and data analysis. So we go through a bunch of stuff, and try and make use of what we have, the knowledge we have across Arch, and then also think about emerging risks that could face the company, which sometimes people don't have time to think about, and it gets thrown to us as you're the risk people to think about it.
Yeah, there's certainly a lot to go on there. And so maybe one of the things I'd like to kick this off for those that are attending the webinar today that may not be all that familiar with cyber insurance. So Janice, maybe you could give us a rundown, an overview of the cyber insurance market, how cyber policies are structured, how it works, some of the similarities, differences from the P&C insurance products that are out there.
Yeah, absolutely. Thanks. And you gave me a heads up this question was coming, so I did a little bit of homework just to have some numbers for everybody. I went back and looked. This market is really a growth market for the insurance industry. It's a new exposure, and as people are learning the risk, understanding the risk, they are demanding more insurance coverage. So when I went back and looked, the insurance market in 2019 was a $5 billion insurance market. This year, it's closer, maybe not quite at 15. So 5 years later, it's up at like 15 billion. And I think various experts around the industry are projecting it could be 25 billion by 2025. We'll see. So it's a growth market. There's more risk. So part of that, I think, is companies understanding what they need to charge for the risk. But I think there's also increased demand. Just both, as I said, companies understanding the risk, understanding that there is a insurance solution for it. I think also as some things have changed externally. For example, the SEC cyber rules that came out in December, like companies always had to disclose that they had material cyber attacks, but I think that's also has companies talking about it more. Boards of directors have been very focused on it over the years because it's part of your job in risk management and oversight of an organization. So there's a lot of things I think that are just creating increased demand for this product. It is an insurance product like any other insurance product, so not particularly exotic. I think the thing that's a little different in the cyber product is it's often a first-party coverage and third-party coverage product. So it's providing coverage for loss of things like a financial loss from a cyber event or cyber crime. It will provide a lot of times what companies are doing, because I think insurance companies and insurers are realizing really the key is good cyber hygiene. So there's oftentimes a component in your relationship with your insurer that they're going to try to help you engineer yourself to prevent losses from happening. So there's a piece of that in it that will then also compensate a company if they've had an event for investigating the cyber loss or the cyber crime. It'll pay to restore computer systems and data. If you have to pay to notify people's data, if there has been a data breach and you have to notify customers, it'll help pay for that. And then provide legal defenses in the event of a claim. So it's really a pretty wide-ranging cover and really can be very helpful, I think, for a company who's looking for an insurance solution to their cyber risk.
Yeah, that's interesting. A question on that. Do you provide blanket coverage, or is it threat specific? Like, can you get a policy for malware or DDoS or ransomware? Or is it sort of all packaged together as
it's fairly all packaged together. Yeah. I think when you think about malware or ransomware or like a cloud outage or something like that, I think those are like causes of loss. So, those, and then we kind of think about how might those losses occur, but generally it's like a coverage for, it's providing you coverage in the event of cybercrime. It's not really saying, what caused it. There are, I would say, certain things like any other insurance policy that it will not cover and it will exclude because either it's covered in other insurance policies, like it's things that are maybe meant to be covered in a property policy or a general liability coverage, or there's some things that I think the industry feels are not insurable. There's just like not enough capital to support that, and so that's, I think, a debate that's going on like across the world right now is like what really is an insurable risk and what risk can the insurance industry bear. And that doesn't necessarily mean it's going to be able to solve all the cyber exposure that that exists in the world. So
Yeah, interesting. So, and I'm guessing that in these policies there may be discounts for people having, robust, cyber threat resilience capabilities, surveillance, those sorts of things.
Absolutely, absolutely. There's so aside from working on offering the cover, I also part of the team that purchases the cyber insurance for my company. So I've been through the process as well. And so everything our underwriters that are selling the product is true when we're buying it. So it is very much if your insurance company can get a good understanding of the protections you have in place, you will effectively, pay a lower premium. And so with that, I think there's a whole kind of new career path on the insurance side of cybersecurity engineers working with insurance companies to help the people underwriting the business understand how the threat evolves. So,
Well, that's very interesting.
yeah.
Something I failed to mention to everybody that's out there tuning into this webinar, if you have questions for the participants, for our guests today, just please put them into the Q&A and I'll pick them up periodically as we go along. And as the right theme comes in, I'll pose them to our guests. So you can be thinking about that. I think it was S&P Global Ratings recently cited a statistic, something like more than 50% of cyber attacks are underwritten by insurers, and that are then passed along to reinsurers. And I think, and again, folks that may not be so dialed into reinsurance markets versus insurance, that may be sort of out there. But if you could help us, walk us through how reinsurance plays a role in this market. What type of structures are used? I know we have these obligatory, facultative, proportional, non-proportional types of structures, excess of loss, all these things. Maybe you can help us kind of like unpack that a little bit.
Yeah, why don't I let Deepak take that one?
All right.
Sure. So thanks, Janice. So in terms of reinsurance, it's the secondary market from the primary companies. And with reinsurance, it just helps primary companies transfer some of their risk and gives them the ability to write more of the risk upfront and then transfer it across to the reinsurer. So it helps the customer in terms of actually providing high levels of coverage that they wouldn't be able to provide without the reinsurance market sitting behind it. It also helps protect capital. So having reinsurance in place helps the primary insurers protect their own capital and helps mitigate earnings volatility. So if you've got reinsurance in place, you're transferring some of the risk across to the reinsurance market. So you can stabilize your earnings on the primary insurance side. And also just having a reinsurance market like in any other products, it just helps diversify the risk across many players. In terms of coverages, again, it's no different from the P&C world or other standard P&C insurance products. In the reinsurance world, we'll offer proportional, non-proportional, stop loss, and we're now seeing more ILWs and ALSs being offered in the market.
You may want to, Deepak, I'm going to interrupt you. You may want to explain what an ILW and an ILS is.
I actually don't know acronyms.
Industry loss warranty. Yeah. Or an insurance-linked security. So it's a securitized product. Yeah.
Yes, it's a securitized product that's triggered by a industry event. So if an event occurs, the loss gets triggered and the cover gets triggered. So we're saying on an ALW, if there was a $25 billion market loss, then the actual cover gets triggered rather than just a small standard cyber events.
Oftentimes these are like issued, so it might be an insurance company behind the packaging, but it'll be issued by kind of as like in a segregated company, and it's collateralized on the back end. So it transfers risk, but it's not kind of your usual insurance policy, but it effectively does the same thing. So
yeah, and this isn't unique just to cyber either, right? This is a standard sort of a protocol for or set of approaches that are used for pretty much all types of insurance, right?
I think so. I mean, I think that the securitized market, this insurance-linked security market, you know, there's more, obviously mortgage is a big place. Like I think all the mortgage insurers are issuing, I think they call them insurance-linked notes there. You know, in the property cat world, right? Like the catastrophe bonds, that's a form of this. And I think that's where it also enables investors who aren't necessarily insurance companies to come in and put capital at risk, and the insurance companies will do the underwriting for you. So I think that's where, as people have seen, there's this need for additional cyber insurance coverage. I think they're starting now, this market is starting to develop on the cyber side. I think just, you know, with any of them, I think particularly for cyber, one of the challenges is, you know, it's a new market and there's not tons of data. So, you know, these tend to be very like quantitatively driven transactions. And, you know, I guess the good thing is there haven't been huge events to date, right? But, and you never wish that happens, but that's what the product's there to provide. And so since there haven't been, you're really, you know, doing your best to estimate when there's not really historical data to work off of. So.
Yeah, that's a tough thing, and that does lead me to that next question that we all sort of suffer with as risk managers, right? We're driving in the rearview mirror with a lot of historical events when we build those models, and maybe they don't exist at the time we need them. But so I can imagine that the data record for this type of risk is pretty difficult to extract, and price premiums is a big challenge. And so, you know, think about trying to estimate loss from, you know, either the probability of an outcome, right, and then the severity of that risk. With the evolution of cyber threats, right, coming, that has to be a big challenge, I would think, in developing analytics to get reasonable estimates of these things. And so, Deepak, maybe you could walk us through some of this, the data and analytical challenges, just generally speaking, that the industry finds itself in trying to get their arms around cyber.
Sure. But just like you mentioned, data isn't there, so we haven't had any big systemic losses. So we can't really rely on historic information to tell us what possibly could happen or how severe it can be. And that's something that we do struggle with. Also in the public domain, if a breach has occurred, people may not be inclined to actually put it out in the public that they've suffered a breach. So we may not have all the data points are actually even out there to even build the model. So just in terms of building and analyzing the threat itself, I think we've got to think about the scenario that we're actually trying to model. If it's a scenario that's a direct infiltration of a company system, it requires different data from a third-party vendor being attacked and then having a supply chain impact. So once you know the scenario that you're trying to model, then you can start thinking about the data that you need, because the data points will be very different according to the scenario that you're trying to build. And just a good example is when people talk about the number of records being stolen, what actually does a record mean? In the banking industry, is one record just one customer? Or is that customer got its own account numbers, passwords, fingerprints, facial recognition? So is that 5 or 6 records just there for that one customer? So when you build models, you've got to actually step back and ask, what is this data that you've gathered? And how do you intend to utilize it? And then on the severity side, we're trying to cover a wide range of industries, and the actual severity will vary by industry, even by the size of the organization. A large company versus a small company would have different operational risk mitigation techniques that could prevent or improve the actual protection they have in cyber itself and the hygiene they have. So that, again, we've got to factor in. And that means that we have to ask insureds hundreds of questions and trying to figure out what they have in place, what they don't have in place. And it's very off-putting for insureds to be asked hundreds of questions by us, different insurance companies, and then everybody's asking it differently. What do they mean by this? How are they going to use it? So it's a struggle data-wise. And data is not always clean either. So there's a lot of manual intervention that goes on in the data that we get. I believe the data is out there, but it's just not structured in a way that's easily utilizable. So that's another challenge that we face in terms of just modeling.
So I think you can tell Deepak and I are in the middle of building a model right now. So this is like the real life struggle that we're going through. And, the point on the hundreds of questions, we had this conversation with our underwriting team, or they brought it up that, and I've been through it as we've tried to place our own insurance is, you need engineers that are going to help you understand this, and you get all this information, but then you're like, okay, I think I need all this. But as we go through and this product develops, you start asking yourself, what really is predictive of what's going to help you understand how a loss is going to occur? And I think that's probably more painful for insureds right now on the cyber side than maybe in other lines of business, because it's new, because we're thinking we think we know, but something might come up next year. It's such an evolving exposure too. Like something that you thought was important last year, this year maybe isn't. I just know from our experience a couple years ago when we were buying our cyber insurance, and we were kind of ready for it. We knew there was a dislocation in the market, that it was going to be a difficult renewal of our cyber insurance program. And so it's been good for me being on the selling of insurance side, now being the buyer. I think one of the things we found particularly challenging is, we purchase what you would call a tower of limits. So no one insurer, we buy enough, right, that no one insurer can give you all of it. So you have a primary insurance company, and usually what's important to them, the other insurers generally sign on to that. And they had a number of questions that year, and it was, as Deepak said, our head of cybersecurity on the phone for hours and interviews with, and we understood that. Then we got to like the next layer up, the first excess layer, and they had a whole different set of questions because they were trying to figure out what made sense in for their company. And then we got to the third layer up, and they had another different set of questions. And it was kind of eye-opening to me on the insurance side, where you're sitting in your organization trying to think through, well, what are the really important things? And just hearing the questions being asked is like, oh, there's people sitting in a whole bunch of different organizations trying to do that too. And we're all kind of coming up with maybe different things that we might think, for whatever reason, given the profile of our book of business, are kind of key questions to ask. And that could be like, I know the team on our side, the operational team, was like, are these people going to stop asking us questions? So we try to be cognizant of that as we, as we kind of design our products and our underwriting teams, the questions that they're asking. But I think because cyber is ever like just evolving so quickly, the underlying risk, it'll probably be rocky for a while. So, I
mean, it feels to me a little not all that different from again, from my world on the banking side of the struggles that people have to go through in trying to measure operational risk, right? Mm-hmm. The more classic form of yes, operational absolutely. Risk. And coming up with, ops loss distributions, right? And fitting things to those and the difficulty that brings. And I think right now there's a whole debate or discussion going on around the Fed's Basel III endgame capital requirements. And there's a lot of focus on the use of advanced models or not on measuring ops risk. And I think a lot of hands have kind of gone up recently saying, you know what, using advanced types of models to do this is you may be kind of somewhat fooling yourself at this moment, but it sounds like you guys are also right in the thick of it, trying to understand how to really use data in a way that can provide you reliable insights onto the trajectory of these losses at the same time when, as we know, risks continue to evolve and they change and all these other things, and it makes life really hard as a modeler for sure on this. I mean, how do you, I guess what I'm asking is, how do you see the efforts by insurers and reinsurers comparing it to what we've experienced for years in trying to measure ops risk?
Yeah, the ops risk, I'll start, and probably because I've been around a little longer. So I remember back in the, before Solvency II was coming into play. So that's 2000, this is someone on the call might be able to correct me. I'm like, forget exactly what year, 2007, 2008.
Just on that, Janice, Solvency II is a European regulatory standard.
Yeah. Thank you, Deepak. Yeah, so European regulatory standard that was really kind of increasing and formalizing kind of a set of disparate regulations, and a lot of it was focused on risk. There's a big risk management component to that. one piece of that was in how do companies model their risk. And there was a component where you can, and it still is, there's a standard model set out by the regulators so they can compare across all companies. But there's also a component of developing a model, an internal model of your own company's risk. It was a conversation. I remember being in London then, and there was a conversation in the London market where people were struggling with the ops risk, and someone on the call might be able to tell me how this all played out. My recollection was there were a group of companies that were had this idea of, well, let's have all companies like submit their ops risk into this pool, and we'll create a pool of ops risk data, and then maybe that's something companies can leverage. And my recollection was, because I remember talking about it within our own organization at the time, was, well, what data is helpful? Like you have, is it just the losses that have occurred, but you have near misses, and like, do you put that in? And then, well, what about the things that didn't happen? And then we started saying, well, what is it going to take in terms of the time and infrastructure of our own people to have them kind of log everything that they do over the course of the day, so then we can figure this out. And we started realizing it was like it was just kind of complicated and not that helpful. And I remember our actuaries were like, or we could just take these 3 data points and kind of string them into a distribution, or maybe call it that. And like, I know in a lot of how we do it, we have a couple different models in our organization. Sometimes you just take you put a charge on top of what you think some measure might be that's predictive of the risk in your organization. If it's for an insurance company, how much premium you have, or maybe it's headcount. I think with our and Deepak, correct me if I'm wrong, but in like our company's based in Bermuda, so with our regulatory filings in Bermuda, there's actually a questionnaire that you fill out where they ask you a number of questions about the governance and control frameworks and how certain things happen, and it leads to a score. And depending on what score you have, then you'll get either a higher or lower charge on top of your required capital, which it seems like it's just, in my mind, it's like a practical, smart way to do it. I think you can do. I've seen people create really interesting ops risk models, but I personally am not completely sold on them yet. I think the more kind of practical one. But I don't know, Deepak, if you would add to that as well.
I think as a model, they have their uses in terms of just thinking through potential operational risks, and then just prioritizing what is high and what is low for the organization. It just helps that thought process, but it's not the end all answer to it.
Right. I think the whole, if you kind of move out of the modeling world, right, and you just think about kind of core risk management, and if you're doing your risk assessments every year and you say, what is my risk, and who's the owner of the risk, and what are the controls we have in place, and then how might that risk play out? I think just, we find going through that exercise regularly, having those conversations, kind of thinking that through, and what are the controls we have, and are they meeting the needs? And then you have an audit function, right, that's going to come in and test the controls. We get a ton of value out of that. Like right there, and sometimes like people bring things up, you're like, wow, I never really thought about that. Okay, like that is a risk. Like, and now let's think this through. Much more, I think, than spending, we'll try to use that, I think, as the team that also works on the modeling to inform us a little bit. But I think just having those kind of open conversations within the organization and is probably the most valuable, at least for me, from a risk management standpoint, the most valuable.
I'm keeping track of some extremely interesting questions coming from folks, and wanted to pose one of these to you. So here's one of these, and Janice, I'll start with you on this one, or Deepak, jump in, either one of you. In the financial sector, have you seen instances where the regulators have agreed to give relief on capital charge for cyber risk after taking into consideration cyber insurance?
Oh,
good question, but I don't think I've come across that.
I don't think I have either, not yet. I mean, so I will say our so as an insurance company, a regulated insurance, all insurance companies regulated insurance company, we prepare a report every year called our own risk and solvency assessment, which is what it is. It's our narrative that we prepare it for our board, but it also goes to our regulator, and there's a modeling component in terms of risk to capital, but there's a component in terms of, and this is like a requirement of all companies, what's your risk management framework?
Yeah.
And I'd say in recent years, at least our regulator has been, as things happen, like adding in topics that they're telling us now, like we want to make sure this is addressed within all the companies' ORSA reports. And a few years ago, cyber was introduced in there, and so I think we do talk about it in there in terms of our thoughts, just our operationally kind of the protections we have, and we talk to them about the cyber insurance we purchase for ourselves. I will say also from a regulatory standpoint, as an insurance company, we there's and this all kind of came up out of the financial crisis, right? Was this idea of group regulation. So insurance companies are, and I'm guessing, Cliff, it's the same for banks. I'm not going to venture into your world, but in we have our lead regulator, right? So we're a Bermuda company. Our lead regulator is Bermuda, but we have operations in the U.S. and operations in the U.K. and Ireland and Australia. And so there's what is called a supervisory college, and that is where all of your supervisors across the world, you meet with them. For us, we meet with them once a year, and they'll ask you questions, like you give a presentation about yourself, but they give you an agenda ahead of time of the questions that are top of mind. And I will say, at least the past 2 years, if not the past 3 years, I can't remember, they have requested that we talk about cyber risk, and not just the cyber risk for underwriting, but our operational cyber risk, how we think about it, how a lot of the questions are about governance, right? So it's not just like, how are you protecting yourself? But I think the questions also, it's good governance, right? So how is it's not making sure it has the proper communication channels and escalation channels and oversight by the board of directors. And I think, I think one of the things that's really kind of driven, I think, an increase in demand in cyber insurance maybe over the past 5 years or so is, as boards of directors have realized, they are being held accountable in terms of the oversight of the risk of the organization, and cyber risk is squarely in their bucket. And so, like, even within our organization, in terms of, we've been talking about like the underwriting or business metrics, there's other metrics that Deepak and I report to our board every quarter on operational cyber risk, and what is in it. They come up through our CISO team. And so, I think there is an expectation, whether it's an absolute, to get back to the direct question, whether it's an absolute, give you a haircut on your required capital, maybe not yet, but I think it's in that kind of more qualitative piece. So.
Interesting. Here's an interesting one too. So as it relates to ransomware, this question coming from the audience here. Okay. My understanding is that attackers seek to understand the level of cyber coverage that a firm holds and will tailor their ransom demands to match their coverage amount. Is there any truth to the notion that having additional coverage makes you more of a target?
I've heard that too. I do not know the answer. I think it's something, we're both smiling because we have heard that as well. I don't know how anyone would know how much cyber insurance you buy. Most companies don't disclose that. So I don't know how someone would know that, but I have to admit that that's a really good question. If somebody knows the answer, hopefully they'll put it in the chat and they'll tell us, because I understand that fear, and it's not the first time I've heard that. I don't know, Deepak, if you would add to that.
Yeah, I think it's something that we do speak about a lot between us, and you can see it happening, but it's more like if a broker had a data breach, they've got all the data that the insurers are purchasing. So maybe that's how the attackers will know how much.
But that, I mean, I think
even that,
if someone had a data breach on a large broker and they were able to get into exactly like that such a specific piece of data, like, I don't even know. Like, I think that it's tough. It's cyber risk. It could absolutely happen. That's
So what has worked and not worked in this market? Big picture.
Wow. Okay. So I think. Go ahead. You go first.
Off the bat, I would just say the number of questions that we're asking our insureds is just too much, and they're being asked in a variety of different ways. So I don't think that's worked that well, because it puts people off buying the product, because it's just not easy for them to go there, fill out 5 questions and understand that. So I think that's been a challenge for the industry as a whole.
I think that, yeah, I think in addition to that, so I think obviously something's working, it's growing at like warp speed, right? So something's working, and it's probably a combination, we talked about it earlier, of a number of things. I think that one of the challenges at least people in the industry struggle with has been clarity of contract wording. So if someone's purchasing an insurance policy, you know, if you're the insured, you want to know what it's going to cover and what it's not going to cover. It's absolutely fair, and like as the person selling the policy, you kind of want that as well, right? You like having the disputes when the claim occurs is good for nobody. I think so. Particularly if we back up maybe 10 years or so, as companies were starting to realize, insurers were starting to realize that their insureds needed coverage for cyber insurance. Sometimes that coverage was seeping into policies that weren't directly cyber insurance policies, either affirmatively, so maybe a property policy affirmatively offering some kind of cyber policy, some kind of cyber coverage, or some other kind of liability cover that had very broad wording that, you know, going back to some of these losses had not happened yet, and so the policy wording just hadn't really been tested, and so there was not necessarily clarity of the coverage. I think because it's a new product, unfortunately, as some large events occur, I think policy wording that was written with the best of intent, there may be challenges to some of the policy wording, and that is, I think, unfortunately, the nature of it being a new product, and that'll be a little bit bumpy as it gets sorted out over time. But I think that's one of that I think is one of the bigger challenges, and it's one that the regulators are very much focused on. We get questions about that. The whole concept, I mean, I think Lloyd's London took like a lead in 2019, right? And really trying to force all the policies there to be very clear in terms of some of the things that they were covering or not. And it's going on across the rest of the world. So I think that's one of the, probably the tough one right now. So.
Yeah. Well, you know, again, another question that's kind of, I'm again monitoring the Q&A here, but it kind of is a question that I had for you both, and it's kind of a topical one, separate and apart from what we're talking about here. But you know, AI, right? Certainly on everybody's radar screen these days. It's in the news all the time, and so I would expect that cyber risk is an area where, you know, the good and the bad aspects of AI could show up. So I guess what I'm getting at is, what are your views on this? I mean, specifically, what should we be watching for? What are you watching for as it relates to the potential for AI to impact cyber risk?
Deepak, I'll let you take that.
Thanks.
Punt right over to you.
Right.
Yeah.
So this is a challenging one, because AI is always developing and evolving. So the potential threats we think about may be here today, but gone tomorrow. But AI, I think, the challenge is more about how do we think the information that we're putting into AI is being used. We don't really have a clear idea of what's being done with that data.
Mm-hmm.
Also, if we put sensitive information into that, is there rise for potential lawsuits that we didn't think about, that we're sharing private data that we shouldn't have in the AI world? On the flip side, I think AI will help us become more efficient. We'll understand our data better and analyze correlations better, and also help operationally make ourselves better. But then the threat actors will use AI on the other side to become stronger and find where the endpoint security areas are failing and start triggering those type of attacks. So it's a tough one. It's always going to evolve, but something that we all know is a threat, and also something that we can use to our advantage.
Yeah, I think I would add to that, to what Deepak said. I think we kind of suspect maybe it will change the speed at which threats can occur, or it makes it easier for the bad guys to more broadly reach out and try to impact more people at once is our suspicion, but it's so new. We don't, we don't know. We've had our board ask the same question as of us, and we've had conversations at our executive management level and with our board in terms of, from a cybersecurity, what are the threats? Where can it benefit you? And then I think to Deepak's point, broader, just in terms of where other risks within the cyber product, pros and cons, risks and benefits, risks and opportunities, I guess, through the terms of AI. So it's like the topic everybody in the world's talking about, right? So
yeah, it is. And as you were speaking, actually, a question just came in about, speaking of AI, what are the cover options available in development, such as wide range of exposure, ...
I don't think I know. I don't think I understand the question.
Yeah, I guess, what are the cover options available on AI? Maybe we'll let that one go by unless we get some clarity on that.
I think
one.
it's maybe somebody asking, like, can AI companies purchase cyber insurance? I don't really know. I don't know the answer to that.
Or maybe it's what's excluded in terms of AI.
Yeah, we'll wait to get a little clarity on that one. In the meantime, here's one. So, I can imagine we're talking about cyber having it's a large tail risk associated with it. Some similar to like a terrorist event. And so after 9/11, the federal government established the Terrorism Risk Insurance Act, right, providing compensation from certain types of terrorist attacks on property. So I guess the question I have here is, do you think a federal backstop on cyber risk events is something that should be looked into more closely in the space, given sort of the pace and direction that some of these things go, and particularly in light of things like we heard a week or so ago from FBI Director Wray on emerging threats that could attack, on a more systematic basis on widespread critical infrastructure?
I think it is happening right now. So there is, and I believe it's the Federal Insurance Office is really taking the lead on this, and someone in government might want to jump in. But I know we are involved within our organization we tend to work through our trade association. So the Reinsurance Association of America, or APCIA, is that what they're with the insurers, the U.S. Insurers Association. So I think it's called APCIA right now. But I'd say at a high level, I think there are. It's a new product, right, in a developing market. I think that there are many solutions that the insurance companies can provide. I think whenever with the government getting involved, it's that, like, how do you structure something that provides the appropriate backstop without crowding out the private market? And that's, I think, maybe a harder one a little bit than the property market, which was a developed market back then, because I think the cyber market's still kind of figuring out kind of what it wants to be when it grows up a little bit, right? Right. So you don't want to crowd that out. I think one of the things that is a little bit different, or I shouldn't say different, I think people need to consider, and this is not my own original thought, this is definitely comes from being involved in it a little bit with some of the trade associations, is the TRIA, or TRIP, or whatever it's called now, TRIPRA. I was actually involved way back when the first one was passed, so I have some knowledge of that back then. And maybe just to give a little bit of a difference in the situation is when September 11th occurred and there were these significant, mostly property losses, right? There was it was absolutely horrible. But when you looked in at the wording in the property insurance policies, and this is really particularly for the commercial property policies, it was unclear. The wording was unclear whether terrorism was covered or not. And the industry, this is my recollection anyway, the industry effectively said, all right, we're going to step up and pay this. It was unclear, and it's the right thing to do. We can't afford to take on this risk going forward. We just do not have enough capital. And so we will exclude it going forward. And I think that was then the beginning of what eventually became TRIA, which is this federal backstop. But one of the provisions in that backstop, or one of the way it ended up working out, was in commercial property policies now, like the companies have to make available terrorism coverage. And then if you own a business, right, when you get your property policy, it says, do you want terrorism coverage? And you say yes, and you pay the premium, and or you can say, no, I don't want it. You have to make available terrorism coverage. That then the premium that pays for it, the insurance companies are on the hook then for some of that terrorism coverage, and then the government provides a backstop beyond a certain amount. That is, that is not like, I think some of the issues that we're dealing with on cyber insurance there are certain things out there like infrastructure or war that they're just like so large, the private insurance market views them as being like not insurable in a way. So how do you kind of reconcile those two? And that, I think that becomes like one of the challenges. I think the other interesting one I've heard is the terrorism risk insurance pool, that's providing terrorism coverage. And I think a lot of the cyber exposures that people, when people fear of a large cyber attack, is it likely some form of terrorism? So how would those two, like, that's more of just an operation, how would those two interplay? So I think that's the other one. So I believe the Federal Insurance Office and I know we've received data calls and we're working with our, trade associations and the industry is very much involved in this. So I think the goal is to get this all sorted out before anything bad happens, right? So people have clarity of coverage, which is, I think, the most important thing, or one of them, getting coverage, but, very important. What you don't want are people thinking they had coverage and then it turns out they don't, or something like that. That's not good for anybody.
No, not at all. But, you think about some of these, the systemic risk aspect of some of this, and you think about attacks on financial market utilities, exchange, but physical plant, right? Electric power grids and whatnot.
Right.
And I guess that, there's no right answer on this, right? From sort of a federal, what you're saying is, hey, from a federal intervention standpoint, there's got to be something, but there's a crowding out effect also from the private capital standpoint, and where that line is
Right.
hard to know, right? Just have to see where that goes.
Yeah, and like there's other, examples out there in the market in terms of like the National Flood Program, right? That's one where the federal government provides coverage. So I think there are some structures out there, and I think sometimes it's like you try to learn from all of those as well and create something. And there are lots of good, smart people trying to think this one through, because I think everybody recognizes that it is a risk and it's a threat, and we need to do the right thing and try to figure it out. So
yeah, it's definitely one of those big big problems. It's going to take a long time to figure, I think. I guess the other question I have, and you mentioned it earlier, but I want to just dig into this a little bit more. Do you see opportunities in using structures? I guess maybe we're already there with ILS and such, like we see in the natural hazard area for dealing with cyber. Can you maybe elaborate a little bit more on where that's coming out in the cyber field?
Do you want to do that, Deepak, or do you want me to?
You go ahead. I was going to say, it is occurring. It's already here.
Okay.
It's just not here on its masses. So it's here. It's going to happen. It's very immature right now, but it will get there.
Yeah, I would say Deepak put it well. I think the data is always the challenge, right? To bring people in to invest in these, they want to feel like they have some idea of what risk they're taking on and exposure. And when you're trying to help people estimate that and get comfortable with it, if the data is not great, and so that maybe drives away some potential investors. I think as the product's been around longer and we are gaining more data, just the modeling's improving, I think maybe more and more investors are saying, okay, maybe the risk return, maybe it's getting to a place where it makes sense for me. So I know there've been probably 3 or 4 of these. I guess cyber cat bonds is maybe the broad way you would term them, just in the past 6 months or so. So I would guess that it'll continue, which is great. It's
Right.
Yeah, I know there's obviously demand for cyber insurance. So, it's our, the more that the industry can figure out ways to meet that demand and help people solve their risk problems, that's absolutely fantastic.
Yeah, that's a good direction for sure. I'm kind of monitoring the time here, and we're kind of winding things down, but another question came in. See if this is one that either one of you could take. We kind of know what physical plant or vehicle features might be key indicators of, say, fire or accident risk, such that the insurance companies don't have to audit every feature of the structure. Are we getting there in the cyber sector? Because now it seems like they're taking the check every nut and bolt approach.
I think that's Deepak's point
I,
of asking 100 questions and making everybody nuts. I'll let Deepak take that one.
so I think we are getting there, I think, just in terms of we're understanding what the key questions are, the key inputs that we need to analyze a risk. Before it was a needle in a haystack as to what could cause a loss and how it's going to materialize. Now we have a better understanding of how that all works. So we can narrow down the number of data points that we need to analyze a risk. So I think it's going to happen.
Yeah, I
Right.
think one of the things I've seen that's smart and makes sense and is the insurance brokers that are kind of placing cyber coverage are coming up with their own kind of applications. So really they'll collate all the data and applications and information that the cyber insurers would generally need, put it into like one template or format, and then send that out to the various markets. So it starts moving away from, oh, here's another question that I need, here's another thing that I need, and then at least I know the broker that we use, and we have it in there. It's in a this system, and then each year you're kind of going back and you're saying, okay, like what parts do I need to update, but I don't need to start from scratch every year. And they're really trying, I think the brokers, and which is their role, right? And I would imagine insurance agents too, they're really trying to make it, and pushing the insurance companies, make it a little bit more seamless for their clients. Because as I mentioned, I sat in a meeting where we were being interviewed by our cyber insurers, and I could tell our CISO was about to lose his cool. He was like, really?
But just with that also, I think there's better utilization of third-party tools. So now we're just knowing a company's website, we could go to a third party and find information without asking the actual direct insured about the actual operational cyber hygiene that the company has. So we can leverage outside tools better too now. So that
Yeah, I
helps
think,
narrow down things.
yeah, I would say on the third-party tools, they're great, and these are things like BitSite reports and science and all of those. I think one of the things we license a number of them as we try to learn, right? Like sometimes you'll find that information can get out of date on some of those. So as I think an organization that uses multiple tools, you're like, oh, that's interesting. Like they aren't necessarily matching up because maybe it's refreshed every certain amount of time. So I would probably caution people when you're using them, it comes with all the pros and cons of any other third-party data set. And so it's a huge help, but I wouldn't necessarily take it as gospel. Like you still need to do, I guess in the underwriting world, we would call it underwriting blocking and tackling, right? Like just like,
Yep.
and how do you balance those? So that it'll evolve, but I'm sure like in the banking, Cliff, in your banking world, like similar, right? Like you use third-party data, and there's
Oh yeah,
lots of good things, but there's challenges as well. So
absolutely. Yeah. Here's a question, and this is probably going to wind us down toward the end because I think they probably spent a bit of time on it. But the question is pretty succinct. It says, what's the board's role and how do you balance cost and risk in securing cyber insurance?
yeah, absolutely. So the board's role is oversight, right? They're oversight of the organization, making sure we have the proper governance and the proper risk management structures. And I think that this became like an active conversation in recent years as cyber insurance became pretty expensive, right? And where the prices are coming down this year, but I know there were companies and having conversations saying, do I spend X amount for additional cyber insurance, or is that better just reinvested back into my organization, into my cybersecurity? It makes me a better a risk, and then maybe I don't need the additional cyber limits. And that is, I think, one that many companies struggle with. And I think at a certain point, and I actually was talking to somebody from a consulting firm who had built as much as I was kind of saying, oh, I know, like these operational models can be difficult. He had been developing an operational model that helped companies, and he ended up using cyber as an example. So I got very interested in it. In terms of, hey, like when I put in place some kind of control to protect the risk, how can I help figure out kind of what benefit does that control give me, so I can then make more informed choices in terms of prioritizing. And it's almost like in a certain way putting a dollar amount on what the control will do for you. So is spending another $1 million on $1 million is a lot of money, right? $1 million on a system that's going to help you prevent versus $1 million on additional cyber limits. Or I think that's what the management teams and the boards, and nobody has the perfect answer. I mean, I think they're doing their best to be thoughtful and make the best decision they can, because it's expensive.
Yeah, no, that's difficult. I remember back in the day just trying to, have discussions with boards about the cost of, pool mortgage insurance and, balancing those things off. And I think I'd like to think that we had a pretty good handle on trying to measure some of those prepayment default risks together. But, it's a struggle, and it's going to evolve as the risk continues to evolve. So that's the nature of the game, I think. One last thing for you, and I always sort of ask this question at the end of my guest, because as you know, as an academic institution, and we teach our graduate students here about things, all risk management. I'd like to kind of get a sense from you. What do you look for in risk talent, particularly those that are coming out of school? What are sort of the qualities of, not just the technical skills, but what are you looking at in good job candidates?
Deepak, you go first.
Sure. So I think communication is key. We deal with internal stakeholders as well as external stakeholders. Some are very technical and some are not. So we have to be able to balance how we communicate risk metrics or risk tolerances to our stakeholders. Programming and analytical skills is definitely a need. Programming, just that there's data that's not structured, we've got to piece it together, and programming just helps us do that and then analyze it better. And it's just being inquisitive is another one. Just think about it from a different angle. There's no one set answer. So you've got to be able to think big picture and then see where things go.
Yeah, no, I'm glad to hear you say that, because I reinforce those views with my students. So that's I'm glad to hear you say that. I think we're at the top of the hour, so I think we'll just end it there. What a great conversation, Janice, Deepak. Thank you so much for taking the time today, and we will be back next month with another installment of the Risk Leadership Series. So hope to see you there. Thank you.
Thank you.
Thank you.